We always say at the top of the show, we're not good about making friends here in the sovereign state of Cramer, but man, do we like companies that are shareholder friendly, companies that consistently boost their dividends, companies that aggressively buy back stock. Take Wyndham Worldwide, WYN, write that symbol down for all you home gamers. The timeshare and lodging and hospitality company that you may recognize Ramada days in. It's also the king of timeshares, a.k.a. vacation ownership interest, with a healthy and growing timeshare exchange and rental biz. This morning, Wyndham reported really just an unbelievably great quarter. So 4-cent earnings beat on a 40-cent basis, so that's a big percentage gain. Revenues that rose 7.4% year over year, raised their full-year earnings forecast for 2011, announced a $500 million increase to their buyback, and this was after repurchasing $255 billion of stock last quarter. Like I said, Wyndham, definition of being shareholder friendly. Oh, and I think you could have seen this beat coming back in February. The company boosted its dividend then by 25%, one of the largest I've seen this year. A classic tale that business is getting better. Wyndham may only yield 1.75%, but the dividend growth is up 113% in the last year. I think this company would have a high yield if the stock would only stay a little bit for right here, but it keeps going higher. High quality problem. Up 51% since I recommended it in February of 2010, a dividend booster when it was trading at $22.54. I like the lodging biz. It's coming back as economies around the world recover, and Wyndham's a terrific shareholder-friendly way to play it with an improving balance sheet and earnings growth that should be in the high teens, low 20s for the next few years. Don't take it from me. Let's talk to the fabulous CEO, Steve Holmes of Wyndham Worldwide. Learn more about this excellent story and the great quarter his company just reported. Mr. Holmes, welcome to Mad Money. How are you, sir?
Terrific, Jim. How are you?
Oh, I'm doing real well. Have a seat.
Thank you.
All right. Now, when you raise that dividend, I'm trying to get people to understand how important that is, putting cash in shareholders' hands. Did you intentionally say, you know what, we got to show our stuff here? What makes the decision to increase it by such a huge amount? Most companies don't do that.
Well, you're right, Jim. And what we did about 2 years ago, we set that we were going to increase our dividend with the rate of growth of the business. And when you take out everything else, look apples to apples from 2009 to 2010, our business grew about 25%. So we increased it 25%. And our intention is to do it again. As the business grows, return more to shareholders.
Now, you say the term the business, but I need you to explain to our viewers, it's really 3 businesses, and which businesses are essential and which ones are going to be with you several years from now, if not all of them, and which are the ones of the principal creators of growth?
Well, they're all growing. All the businesses are growing. Over the next couple of years, lodging will probably be the fastest growing business because as the recovery comes through the lodging industry, which the recovery will probably last 5 or 6 years, we'll have a good wind of the sails. But also our exchange and rental business is growing, and our timeshare business, which used to be our fastest growing, we're kind of holding it back now from growth. That's intentional. It could grow more quickly. We're just trying to take that capital and deploy it other places.
Let's talk about a business, the exchange business, for a second, because I don't know any. You were kind enough to mention some I almost said second rate. I want to be a potential competitor coming public,
right.
But explain to people how you have a unique business model. You're really the broker who doesn't principal or put money down to be able to make it so people have their best luck getting in and out of timeshares.
Exactly. That's our RCI company, the exchange company, largest in the industry, about 3.8 million members who are part of it. They pay a membership fee to be a member and then a transaction fee when they transact. So if you bought timeshare down in Myrtle Beach, I don't know if you've bought it there yet or not, but
I haven't got to it yet.
If you bought timeshare there and you wanted to go to Hawaii, you do that through RCI. That's how you do your exchange. So it's a terrific business. We're by far the leader in that industry. It's been a great business for us since 1996 when we bought it.
All right, Steve, one of the things that you do in your conference call, and I urge everyone, go through this conference call because it's really transparent and clear if you want to learn how a company's growing and executing right. It's right up front. You say, let me spend a few minutes on some recent announcement. The announced spinoff of Marriott's timeshare business. Now, this is a great company in the business. We all know it.
Fantastic.
And you're talking about how that could be a way to measure your own business. That's a gutsy thing to do. You're saying that, look, our business is basically undervalued when you see someone else come public. What does it mean to have a competitor bring public this division? What could it mean for your company 2 or 3 years down the road?
That's a great question. The timeshare component of Marriott is much smaller than it is for us. It's about 20% of the business. So it's less visible to investors. They look at Marriott as being a hotel company. The entire Marriott organization, extremely well run, great organization, great competitors of ours. By spinning that business off, what it does is it allows investors to see it more transparently, to see the timeshare business. We do a lot to put out disclosure and talk about our timeshare business, which is a terrific business, but this will give it more of a comparative out there in the marketplace. Our timeshare business larger for us by far than timeshares for Marriott, but both great businesses.
Well, what we did was, my staff, we were looking at some of the parts if timeshare comes at a certain price. Now, maybe this is pie in the sky, but we think that your company could be worth $45 to $50 right now, as soon as that thing comes public, if it comes through at a certain multiple. Crazy or maybe realistic?
Not impossible. Frankly, that would get us probably closer to the comparative market multiple to others. I think actually an analyst just today put that kind of a 45 to 50 price range.
So Friedman Billy's do it. I mean, I felt that was too conservative because I think that it underestimates the core broker business that you have, which I love, and we happen to like the hotel business coming back so rapidly. You were also very candid in your conference call about the notion of how you used to finance a lot of. You used to do these asset-backed bonds. That market has come back tremendously. Yeah. I always thought your bonds were just a terrific credit because people don't skip on paying these, but you seem reluctant to go back aggressively in that business.
Well, we still do it. In fact, we just printed a ABS deal recently, the $400 million deal that was a great execution, one of the best we've ever had. Right. But when the question came up on the call about do we want to get rid of the business we have, which is selling other people's timeshare, selling other people's product that they've built, so we're a completely asset-light model and we're just a broker, I said, well, yes, we're going to do that, but do I want to completely then take on the debt from those sales and take on those receivables, and have to issue out the debt? Right now it's fantastic, but I'm just saying you can't tell. We've never seen a market like we saw over the last 3 years, and I'm just saying I'd like to be cautious. I want to keep my options open. I want to be flexible, and that's why I said, I don't want to run in and do everything on our own.
Okay, I thought that was a great answer to it. Now, one last question. Your company never used to throw off this kind of cash. I mean, now because you're not building these hotels. When you guys sit there, how do you decide dividend versus buyback? Because this buyback is so aggressive that I think it is, so few of them actually, I think, power stocks higher. Your buyback is moving. It's making this stock go higher. How do you decide dividend buyback?
Yeah, well, I don't know if the buyback is making the stock go higher.
My
that
judgment
might be
is
your
there's
judgment.
A scarcity of stock out there for sale. Is my judgment.
Okay. I think it's because people are understanding our business better, but we can all have our opinions.
Right.
The fact is that we've kind of established what our dividend rate will be, and we kind of know where we want it to be, and we're going to keep raising it as we grow our earnings. But the dividend is the buyback then is a result of if we don't have acquisitions we're doing that are tuck-in acquisitions, we're going to be buying back stock. We've said that for the last 2 years, and we're doing what we said.
I think people are finally listening. They should be listening because your stock is going to go much higher, whether you break it up, whether you just keep doing what you're doing. It's one incredibly cheap stock and a really well-run organization. You do a great job, Steve. This is Steve Holmes, Chairman and CEO of Wyndham Worldwide. Yes, it's had a big move. I think it can go much higher. Stick with it. Stay with Cramer. Thank you.